Catch you for closing trades. Joining us now is Dinshaw Irani, CEO, Helios Mutual Fund. Dinshaw, hi, morning. Uh, the earnings season, Q4 earnings season is over. How do you look at the earnings? Do you think the mid caps, which are growing better than the large caps, will outperform in the current financial year?
Thank you, by the way, for having me on your show, and a very good morning to you and your viewers. So let me start off with the earnings season. The March quarter was definitely a surprise, a positive surprise. Though overall headline numbers, if you see the headline numbers for NSE, the Nifty 50, which is the largest of large cap that India has to offer, it was up only, earnings growth was up only 6%, right? And then you go down to a NSE 500, which is the broadest index that India has to offer. That was up some 15%, and that was on the back of 28% growth in mid caps and from 40 odd percent, 41, 42% growth in the earnings for the small cap universe. So now you can imagine why that 15% came about. And that's why we've continually said that even though on the PE basis, standalone PE basis, the mid cap universe looks the most expensive, followed by the small cap universe, and obviously the cheapest looks the large caps. But if you divide that by growth and look at the PEG, which is where the real crux lies, the cheapest then turns out to be the small cap universe, and followed very closely by the large mid cap universe, and the most expensive turns out to be the large cap. So that's why we continue to look at mid and small caps. In fact, in the month of the May, which went by, you'll see my portfolio once it comes out. You'll see the mix in our portfolio also. Overall portfolio is changing. We're moving away from the large caps and getting into somewhat into mid and small caps. And we're constantly looking at identifying new names wherever it's possible. So that way.
So,
Wherever the correction has happened, we've been picking up the mid and small caps.
Dinshaw, I've been looking at your May portfolio, two big exits, Tata Motors and Titan. Why?
Well, I think Tata Motors was obviously because that was the the CV part of Tata Motors, the Tata Motors CV. That we exited because of the rising crude prices. We had taken a call that, look, may not be sustainable. And actually, we anyway were looking for, as I said, for ideas to move out of large caps. And that was the same reason was held good for Titan. But Titan, I think, has done wonderfully well. In fact, in a recent analyst meet, they've been very clear of how their growth rates are going to pan out for the next couple of years. So maybe we may have taken an early call on Titan, but we are very clear on the CV part, the Tata Motors CV part.
Interesting additions, Adani Enterprises, Dixon and Computer Age. Adani, we've seen a lot of domestic funds now getting into it now that the overhang is over. What is your view on that group? Because Adani Ports is also one of the big holdings for you.
Yeah, so basically Adani Enterprises was mainly because of the reason that they're into a melange of products, right? And the biggest one is obviously the photovoltaic, the solar energy, rather, the foray that they made. I think that's what excited us, and we've seen the solar part of the market moving up quite appreciably. We know that if anybody can make it a success, it has to be Adani, and that's why we got into the enterprises. Dixon obviously was becoming a steal at those prices. We picked up at much lower prices than what they are today, and that was mainly because the Chinese JVs had been allowed, and with Dixon rather, and that was the biggest overhang for them. And we're expecting some more few approvals coming their way. And obviously, he's the largest outsourcing play for India as such, and that's why. And obviously, one of the biggest beneficiaries of the production-linked incentive scheme. So that's why we took a call on Dixon. CAMS was basically a call on the market. As in with so many mutual funds coming in and him taking shares away from, there are only two players anyways, but him doing a very commendable job in that space. So that's why we had picked up CAMS. So.
Makes sense. Dinshaw, you mentioned prior to this that, firstly, hi, it's been a while. So you mentioned prior to this that you're looking at pockets which are falling or which have fallen, and which now start to look attractive to you. What would those be? What would probably the next couple of months look like in terms of buy calls for you?
So there are quite a few of those. I mean, if you've seen the portfolio, we added quite a few small caps where we had seen that there have been falls happening as such. Mainly the new age companies, D2C plays or B2C plays and stuff like that. And obviously in the consumption space, we've also looked at auto ancillaries part of the business where we've added quite a few names where the collapse has been. So these are a few sectors that we picked up. We did trim a bit on the large cap bank space because we felt that the bulk of the heavy lifting is done. When we needed safety, that was the sector which had saved us. And now from here on, you need to move on to certain growth sectors. And that's what we've done going forward. So,
How do you look at, you know, do you have enough cash now with you, or you're fully invested at this point in time?
we never hold any cash. We always keep investing whenever we see opportunities because we believe fairly well that India has enough opportunities to invest in, and that's why there are enough ideas in the market. Keeping cash is definitely not the way if you want to work in a market like India. So we've always invested. We do keep getting flows on a daily basis. So maybe at some point in time, you'll see some cash lying around, but it's fairly deployed quite quickly as such. So that's how we
Taken. Dinshaw, with regard to metals, what's the call now? It's a tricky place because you continue to see a decent uptick in metal and commodity prices, but stocks have run up as well. Do you believe that we're largely even, Steven, in terms of risk reward now?
So wherever there is protection to the industry, I mean, you've seen there's import duty curbs. I mean, import duty is applied. There's sin tax and not sin tax, rather there's additional taxes applied for Chinese imports and stuff like that. We don't like those kind of sectors where the protection is given. And frankly, I mean, if you look at the global, if you're competing in the global markets, China has a very big overhang in metals. And that's why we are very careful in metals. And frankly, I mean, we never like cyclical plays anyways. So that's why we're away from metals. Obviously, the prices have run up on the back of the fact that the global prices moved up and India in particular moved up much faster because of the curves. But the day China decides that their idle capacities then come to when they have to use, that will be the day when you'll see prices correcting in a big way globally. Maybe not in India as much, but so that's why we are away from that sector and we continue to remain away from that sector.
Dinshaw, I'm looking at your portfolio for the end of May 31st actually. I can't see any pharma or healthcare stocks in that. Are you, bearish on that segment? Because that's something which has been very active as well.
No, so we're away from pharma, which is basically US facing. The reason being that most of the US facing pharma companies are normally on a treadmill in the sense that some of their products go off patent, rather the exclusivity goes away, and you see them trying to get those revenues back again by introducing new products. So it's always on a treadmill, literally trying to launch new products every year, and a lot of expenses go into that. Some click, some don't. That's why we don't like that particular one. But we do have exposure to CDMO plays. We have domestic pharma plays in our portfolio, and our biggest exposure to healthcare is via hospitals. I think that is where the real crux lies, because fun lies rather, because hospitals are like hospitality. There are limited rooms which are available for quality healthcare. With India per capita is moving up, GDP per capita moving up, I think that is one area which will be, which every other consumer who can afford it would want. And that's why we believe that hospitals are the right way to play the healthcare segment rather than anything else in India.
To some extent, Dinshaw, last year was a tough year for consumer durable companies. Do you believe this year, with El Nino and with the kind of weather we're experiencing here in Bombay, things could change this year, FY27?
So basically, consumer durables, most of the plays are the cooling ones, the ACs and refrigerators and stuff like that. The feedback that we got from the ground is that despite El Nino, there's not been much uptick, at least in the air conditioning space. There have been some pickup in the the I think it's fans and all, which where the pickup has been. But frankly, I mean, that's a very small space to even look at. So we don't like to be curved with such, and there are limited amount of exposure that you can take out here. Frankly, I mean, and plus there are a lot of competition also in that space. So that's why we avoid these kind of names, and you won't find them in our portfolio, at least going forward. So.
Dinshaw, always a pleasure having you here and providing context to everything that's happening with regard to Indian markets. Thanks so much.
Thank you.